Welcome to today's Explainer. Okay, we've got a fascinating mathematical mystery on our hands today, hiding right in plain sight. We're looking at Maximus, ticker symbol MMS. If you're a fan of a good financial puzzle, you are definitely in the right place. We're going to dig into the raw data, the valuation metrics, and the historical performance to answer one really big question. What exactly happens when a company's stock price completely detaches from its financial reality? I mean, is the market seeing something the math just isn't, or is the math literally screaming at us to buy?
Okay, let's dive into this because the tension here is wild. Look at what current shareholders are dealing with. It's a pretty brutal reality right now, with a year-to-date return sitting at negative 30.54%. The stock has just taken a massive beating. But, and here's the crazy part, at the exact same time, discounted cash flow models are pointing to a huge 48.71% margin of safety. It's a shocking paradox, right? The market is aggressively selling off, yet the absolute mathematical foundation of value investing is suggesting this stock is sitting at a massive discount.
So, to make sense of all this data, here's our structural roadmap for the explainer. First, we'll look at the mystery disconnect. Then, unpacking valuation multiples. Third is profitability and capital efficiency. Fourth, free cash flow health. And finally, dividends and historical returns. Let's get right into it.
Starting with Section 1, the mystery disconnect between price and fair value.
Before we can figure out why the stock is dropping, we really have to establish our baseline here. And wow, the gap is staggering. The last closing price for Maximus was $59.36. But our intrinsic value calculation? According to discounted cash flow metrics, that puts the fair value way up at $115.72. The stock is currently trading at roughly half of its mathematical fair value. Now, a gap this wide really only means one of two things. Either the underlying business is fundamentally broken, or the market has just completely mispriced a high-quality asset.
Moving on to Section 2, unpacking valuation multiples, a historical discount.
Now, what's really interesting here is how this proves whether the stock is actually cheap compared to its own history. Look at the multiple compression across the board. The current price-to-earnings ratio of 9.05, that is a staggering 49% drop from Maximus's own three-year average of 17.76. Think about that. The market has essentially cut the premium it's willing to pay for these earnings straight in half. And we're seeing the exact same story everywhere else. Price-to-sales dropped to 0.58, and price-to-book is down to 1.88. What we're looking at is severe, systemic multiple compression.
And it gets even more extreme when we factor in growth. The current PEG ratio sits at this ultra-low 0.22. Now, as you probably know, traditionally, a PEG ratio of 1.0 means the price perfectly aligns with earnings growth, right? And anything below 1.0 usually signals value. But 0.22, that isn't just regular value. Mathematically speaking, that is screaming deep value.
Of course, just to make sure we aren't being totally fooled by corporate debt here, we have to look at the enterprise value. And the EV to EBITDA ratio is currently sitting at 6.21. That's well below the trailing 12-month average of 7.68, and it's a super steep drop from its three-year average of 9. So even when we include debt, the entire enterprise is just getting cheaper. Literally every single valuation lens is confirming this exact same downward trend. It looks undeniably cheap on paper.
Which brings us to Section 3, profitability and capital efficiency. Is the engine broken?
So this shifts the whole narrative, right? We have to ask, if the stock is really this incredibly cheap, is the underlying business actually failing? To answer that, we turn to the master key metric for business quality, return on invested capital, or ROIC. Just to make sure we're all on the same page, this basically measures how efficiently a company allocates the capital under its control to generate profitable returns. Basically, for every dollar they reinvest into the business, how much profit does the engine spit back out?
And this brilliantly illustrates the paradox we're dealing with. While the stock price is plummeting, down 30% this year, the company's actual operating efficiency is soaring. Just look at these current metrics versus their three-year averages. The current ROIC is 11.94%. That's significantly higher than its 8.90% average. Return on equity? That's jumped to 21.62% from an average of 14.88%. Even the net profit margin has expanded, going from 4.90% to 5.89%. So the business engine isn't broken at all. Actually, mathematically, it's running vastly more efficiently today than it has over the entire last 3 years.
And it's important to quickly note that they aren't achieving these margins by starving the balance sheet either. Liquidity is visibly improving. They have a really strong current ratio standing at 2.34 right now. That is up nearly 38% from its 3-year average of 1.70. So we're looking at expanding margins, better capital allocation, and really strong liquidity.
All right, let's move to Section 4, Free Cash Flow Health, the short-term squeeze.
Let's see how this builds our understanding of the current market fear. Because if valuation is this cheap and profitability is improving, why on earth is the market panicking? Well, the crucial point here is this clash in cash flow momentum. Because the price has dropped so much, you're getting a fantastic free cash flow yield of 7.01% and an earnings yield of 11.92%. And over a 3-year horizon, free cash flow has actually grown at a massive 33.14% annually. But take a look at the trailing 12 months. Free cash flow just dropped by a sharp negative 22.17%. That sudden, short-term deceleration in cash generation, that's the culprit right there. It is clearly spooking investors and driving the sell-off, even though the long-term averages look absolutely solid.
Finally, Section 5, Dividends and Historical Returns, Rewarding the Patience.
Let's look at how long-term shareholders are being compensated while they wait for this price-to-value gap to close. Because when you find a disconnect this big, the waiting game begins. Right now, investors are being paid a 2.22% dividend yield just to hold the stock. But what makes this really attractive is the safety of it. The payout ratio is extremely low, just 18.86%. They're using less than 19% of their net income to cover that dividend, which leaves them plenty of room to absorb that short-term cash flow hit we just talked about. Add in the fact that the dividend has been growing at over 5% annually for the last 3 years, and you're basically getting a very safe, growing premium to just sit back and wait for the market to wake up.
And patience is for sure a requirement with this one. If we walk through the historical return timeline, the recent past has been completely brutal. Down 30% year-to-date and down over 29% on a 5-year horizon. But look at what happens when you stretch that timeline out a bit further. A 10-year hold yields almost 23%, and a 15-year horizon, that shows a massive 238.97% return. It's a perfect example of how deeply cyclical market sentiment can be. Looking solely at a 5-year window can totally mask the long-term wealth-building potential of a company that is fundamentally profitable.
Which leaves us with the ultimate question, doesn't it? We have this incredibly profitable, highly efficient business that is trading at a staggering 48% margin of safety compared to its fair value. But on the flip side, we've got shrinking short-term cash flows that have completely terrified the market. So what do you think? Is Maximus a classic value trap? Or is this the ultimate bargain hiding right in plain sight? The data is all right here, but the final conclusion is entirely up to you. Thank you so much for joining me for this explainer today. I strongly encourage you to dig into these metrics yourself, see what you find. Keep learning, keep analyzing, and I will see you next time.